Welcome to another episode of Living Fire. Subscribe now so you never miss out on any of our latest uploads. Let's get into the video. In addition to death and taxes, inflation is another phenomenon that we can expect with near certainty over a period of time. The US has actually gone through many brief periods of deflation, but in general, economic progress is accompanied by inflationary pressures. Inflation may occur when there is too much money in the system, which leads to an escalation in the price of goods. Of course, if a household's two primary sources of wealth creation, asset and income appreciation, rise at a rate equal to or greater than inflation, the negative effects of inflation are neutralized. Yet, as we've seen time and time again, that usually is not the case. While the minimum wage has increased, the overall price of goods has outpaced the average salary increases of recent years. The basics of inflation. In economics, inflation is a quantitative measure, one of quantity over quality, tracking the rate of change in prices of a standardized basket of goods. Inflation is defined as an increase in prices over time, and the rate of that increase is expressed as a percentage. The most common economic reports used to measure inflation are the Consumer Price Index, or the CPI, the Producer Price Index, or the PPI, and the Personal Consumption Expenditures Price Index. The PCE Price Index is the Federal Reserve's preferred inflation gauge. The PCE is a broader measure than the CPI and is weighted based on consumption measures used to derive the gross domestic product, rather than on a household spending survey as the CPI. CPI measures the weighted average urban consumers pay for a standardized market basket of goods and services. It is reported monthly by the Bureau of Labor Statistics, or the BLS. PPI is a weighted average of prices realized by domestic producers. It includes prices from the first commercial transaction for many products and some services. It is also reported monthly by the BLS. The PCE Price Index is a broader measure than the CPI of the change in the price of goods and services purchased by consumers. It is released monthly by the Bureau of Economic Analysis of the U.S. Department of Commerce. All three of these indices provide an alternative core reading, excluding the more volatile food and energy prices. Another alternative inflation measure is the Trimmed Mean PCE Price Index from the Federal Reserve Bank of Dallas, which excludes from each monthly calculation spending categories, with the most extreme price moves in either direction. How inflation affects asset values. While inflation's effects on the economy and asset values can be unpredictable, history and economics offer some rules of thumb. Inflation is most damaging to the value of fixed-rate debt securities because it devalues interest rate payments and, as well, repayments of principal. If the inflation rate exceeds the interest rate, lenders are in effect losing money after adjusting for inflation. This is why investors sometimes focus on the real interest rate, derived by subtracting the inflation rate from the nominal interest rate. Longer-term fixed-rate debt is more vulnerable to inflation than short-term debt because the effect of inflation on the value of future repayments is correspondingly greater and compounds over time. The assets that fare best under inflation are those assured of bringing in more cash or rising in value as inflation increases. Examples would include a rental property subject to periodic increases in rent or an energy pipeline charging rates tied to inflation. The worst tax. Inflation is often referred to as the worst tax because its effects go unnoticed by most people. Hypothetically, earning 4% in a savings account while inflation grows at 7% makes many feel 4% richer. In fact, they are 3% poorer. That's why it's important for households and investors alike to understand the causes and effects of inflation and how to plan so as to ensure that their assets maintain their purchasing power. Here are three investment approaches everyone should consider as ways of protecting their hard-earned wealth from the ravages of inflation. Although inflation may be less dramatic than a stock market crash, it can be more devastating to your portfolio. Invest in stocks. Despite the lack of confidence most people express about stocks, owning some equities can be a very good way to combat inflation. Think of your household as a business. If a company cannot properly invest its money in projects that will deliver a return above its cost, then it too will fall victim to inflation. So the basic premise of business success is that corporations will sell their goods at increasing prices, which will lead to elevated revenues, earnings, and inevitably stock prices. Some of the best stocks to own during inflation would be in companies that can increase their prices naturally during inflationary periods. Commodity resource companies are one example. Products like oil, grains, and metals enjoy pricing power during periods of inflation. The prices of these items tend to go up as opposed to, for example, the price of a computer, which is subject to manufacturer and distributor price adjustments. Still, price increases aren't enough to protect against inflation. If a company experiences rising expenses, price increases alone are not enough to maintain equity appreciation. That's why grocery stores, which may benefit from an increase in food prices, may also suffer from an increase in their cost of goods sold. Look to invest in businesses such as commodity firms or healthcare companies that possess the strongest profit margins and generally the lower cost of production. Finally, never underestimate the value of dividends during periods of inflation. Dividends increase the total return of a portfolio. Invest in a home. When done for the right reasons, like buying a home to live in, real estate is always a good investment. Problems occur when a buyer's goal is to flip the property they just bought at a profit. Although experienced real estate investors are able to find hidden values in properties, the average person should focus on purchasing a home with the intent of holding it, even if only for a few years. Real estate investments do not typically generate a return within several months or weeks. They require an extensive waiting period in order for values to increase. As a home buyer, unless you're paying cash, you're likely to put some money down and take out a loan, known as a mortgage, for the remainder of the purchase price. And there are different types of mortgages. Fixed rate and adjustable are the most common, but the underlying principle is the same. You pay off a little of the principal each month until you're left with ownership of a debt-free asset that should continue to appreciate over time. If you get a fixed rate mortgage, you end up paying off future debt with cheaper currency if rates increase. But if rates decrease, you're still responsible for the fixed amount. Various factors should be taken into account in order to determine your best mortgage option. Like land, home prices tend to increase in value on an average year-over-year basis. It is true that real estate bubbles are usually followed by correctional periods, sometimes causing homes to lose over half of their value, but still, on average, housing prices tend to increase over time, counteracting the effects of inflation. Invest in yourself. By far, the best investment you can make to be prepared for an uncertain financial future is an investment in yourself, one that will increase your future earning power. This investment begins with quality education and continues with keeping skills up to date and learning new skills that will match those most needed in the not-too-distant future. Being able to stay on top of the business's changing needs may not only help to inflation-proof your salary, but also recession-proof your career. And with that, we've reached the end of this video, all about high inflation and how to act when it comes. If you enjoyed this episode and you found it helpful, don't forget to give a thumbs up and to subscribe to our channel for more content just like this. Thank you for watching, and we'll see you in the next one.